It all started with an idea. In 2008, Satoshi Nakamoto published the Bitcoin white paper, describing a digital currency secured by cryptography and a public ledger called the blockchain. On January 3, 2009, the Genesis block was mined. Initially, Bitcoin was a digital curiosity among enthusiasts. That changed on May 22, 2010 when Laszlo Hanyecz bought 2 pizzas for 10,000 Bitcoins worth about $41. This first real-world transaction, now celebrated as Bitcoin Pizza Day, gave Bitcoin its first price. In February 2011 it reached parity with the US dollar. Media attention pushed the price to over $30 by mid-2011, introducing Bitcoin's volatility. The early days saw grassroots growth as developers built wallets and exchanges. This established a core community believing in a decentralized financial system. The rise from $0 to $30 wasn't driven by Wall Street, it was a movement powered by passionate believers. Bitcoin's journey from an idea to a tradable asset was just beginning. The world was about to witness the birth of a new financial era. 2013 marked Bitcoin's first major boom and bust. The price skyrocketed from $13 to over $260, fueled by financial instability and new users. Mt. Gox, once a Magic the Gathering card site, became the dominant Bitcoin exchange, handling over 70% of all trades, but Mt. Gox was plagued by technical failures, triggering panic and trading halts. The price tumbled back to $50. Bitcoin slowly recovered, and by late 2013, renewed interest from China pushed the price past $1,000. In early 2014, Mt. Gox halted withdrawals and went offline, revealing a massive security breach of 850,000 Bitcoins. Bitcoin's price crashed, triggering a harsh crypto winter. The Mt. Gox collapse became a cautionary tale. Out of the ashes, a stronger ecosystem would emerge. Bitcoin's story was far from over. After Mt. Gox, Bitcoin languished, but development continued. By 2017, the stage was set for an epic bull run. Bitcoin started the year under $1,000. The rise of ICOs brought a flood of new money and attention to crypto. Media coverage exploded. Stories of overnight millionaires fueled a powerful FOMO among retail investors. Bitcoin smashed through $5,000 in October, then $10,000 in November. The momentum was unstoppable. In December 2017, Bitcoin soared to nearly $20,000. The total crypto market cap topped $500 billion. Major financial institutions took notice. Bitcoin futures launched, signaling mainstream acceptance. For a moment it felt like a new financial era had arrived. But the bubble burst, exchanges crashed, fees spiked, and regulators issued warnings. By early 2018, Bitcoin's price had fallen over 65%. The crash continued, bottoming out near $3,200 by year's end. The great bull run was over, leaving behind broken dreams and another long crypto winter. The cycle of boom and bust had become Bitcoin's signature. Yet each crash brought new lessons and stronger resolve. The world was watching and learning. Behind every price chart are stories of triumph and heartbreak. The Winklevoss twins, mocked for their early Bitcoin bet, became billionaires by holding through crashes and bear markets. On the flip side, James Howells accidentally threw away a hard drive with 7,500 Bitcoins, worth over $150 million, at the 2017 peak. His desperate search for the lost fortune became a cautionary tale about self-custody. The 2017 bubble saw many everyday people gamble and lose, buying at the top and getting wiped out in the crash. Online forums filled with stories of financial ruin, highlighting the dangers of speculative mania. But luck played a role too. In 2010, Christopher Koch bought 5,000 Bitcoins for $27, forgot about them, and years later discovered he was a millionaire. He sold some to buy an apartment, fueling dreams of crypto riches. These stories show both the promise and peril of Bitcoin's volatility. Fortunes can be made or lost in the blink of an eye. The line between genius and disaster is razor thin. In crypto, timing and luck are everything. The human drama behind the numbers is what makes Bitcoin's story unforgettable. The 2018 crash brought another crypto winter, but this time, institutions quietly entered the scene. Companies like Fidelity and Grayscale built infrastructure for big investors. Bitcoin's narrative shifted from speculative toy to digital gold. In March 2020, the COVID-19 pandemic triggered a global market panic. Bitcoin crashed over 50% in a single day, but unprecedented government stimulus and fears of inflation made Bitcoin's fixed supply more attractive than ever. Legendary investors like Paul Tudor Jones and Stanley Druckenmiller publicly backed Bitcoin as an inflation hedge. Public companies like MicroStrategy and Tesla added Bitcoin to their balance sheets. The price soared, breaking its 2017 high and reaching nearly $69,000 in November 2021. This rally was driven by institutional capital and a powerful macroeconomic narrative. Bitcoin had arrived on Wall Street's stage, the market matured, but volatility remained. The world now saw Bitcoin as both a risk and an opportunity. The institutional era had begun. Bitcoin's place in the global financial conversation was secure. What can we learn from Bitcoin's wild ride? First, volatility is the norm, not the exception. Bitcoin's price swings are part of its evolution as a new asset class. Anyone investing must be ready for extreme ups and downs. The most successful investors are those with patience and conviction, not day traders chasing hype. Time in the market beats timing the market. Beware of FOMO. Media mania and public frenzy often signal overheated markets. Do your own research and understand the risks before investing. Bitcoin's history is one of resilience. After every crash, it has come back stronger. The network has never stopped, despite countless attacks of its demise. Each cycle brings new challenges and new learning. The future is unwritten, but Bitcoin's story is one of survival and adaptation.